Hi there, I'm Pamela Ambler. Welcome to I See Your Trade, the show that looks ahead with fresh insights and data-driven deep dives. In this episode, the global energy crisis, a threat or an opportunity? The global energy crisis continues to hurt households, businesses, and entire economies. Prices for gas, coal, and oil have skyrocketed all around the world, and that's brought with it sky-high inflation. I'll be joined by our guest, Stephen Schork, editor of the Schork Report, who provides fundamental and technical analysis on the energy market. I See Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade up to IC Markets. Now let's start by setting the scene. With the Northern Hemisphere heading into winter, the global energy crisis is about to flare up. What started as a supply shock after Russia's invasion of Ukraine is now ratcheting up to double-barreled supply and demand price blowout. Before the conflict, Russia supplied Europe with about 40% of its natural gas. Russia halted supplies through its Nord Stream 1 line that pipes gas into Germany and says it won't resume supply until sanctions are lifted. And after the underwater explosions at the gas pipeline, even if they wanted to resume supply, that could take time. In an unprecedented move, Germany has nationalized one of the nation's largest gas companies to secure domestic supply. Europe's most energy-intensive companies have begun to shut down. Dozens of plants across a range of industries, such as steel, aluminum, fertilizers, and the power industry itself, have been forced to shut up shop as sky-high gas and power prices make their businesses loss-making. The crisis isn't contained to Europe. The United States is wrestling with the worst energy crisis in nearly 5 decades. The world is looking for alternatives to natural gas. The price of coal is up almost 150% since the beginning of the year, and nuclear energy is now back on the political agenda. Environmentalists are calling for more renewables to fill the void, but mass adoption just can't scale quickly enough to meet demand. My guest today is one of the world's leading commentators on energy forecasting and trading. I'm joined by Stephen Schork, editor of the Schork Report, who provides fundamental and technical analysis on the energy market. One of the benefits of doing a VODCAST is that you can see the charts that we're about to talk about. So if you're listening via audio only, we encourage you to turn on the screen now so that you can see the charts. But for our listeners, we will also talk you through the data. Let's jump right in. This first chart, Stephen, tells us a lot about the energy crisis currently unfolding in Europe. Talk us through what we're seeing on the screen here.
Yes, absolutely, Pamela. So the European Union was unhappy with the cost of carbon, that is carbon permits. These are the permits that fossil fuel users have to own to allow them to increase their emissions. So what has happened at this point was the EU, unhappy with the transition out of fossil fuels, cut the supply of carbon permits. Now, economics 101, when you cut the supply of something that is in high in demand, of course, prices are going to rise. So on this chart, what we've seen is the cost of carbon has doubled over the past 2 years. Now, what this means is that the EU had it half right. They did jack up the cost of carbon, but instead of moving out of fossil fuels, i.e. coal in this instance, the industry could not move into renewables because the renewable complex, the renewable market, is not ready for prime time. Renewables are great in the future, but as far as current infrastructure in this market segment, fossil fuel users or coal burners had to switch over to natural gas. And that set the scenario, and of course, what has compounded it now since then, the other day we saw what is now being deemed sabotage on the Nord Stream 1 and 2 lines of Russian gas coming in under the Baltic Sea into Europe. That gas, or those pipelines, now are likely never going to be operational again. So Europe has lost a key source of their energy going into the winter. So clearly this is going to be a very expensive, very volatile winter for European consumers.
Yeah, very volatile winter ahead indeed. Now this next chart, it looks similar to the last one, but it's giving us more perspective on the full story. What's the takeaway from this chart?
Yeah, absolutely. It is a situation where As we've seen, prices have surged nearly 1,700%. We're up about 1,000% over the past couple of days, and this is indexed over the past 2 years. So we certainly have this situation where prices are high, and they're going to remain high going to this winter, both in Europe and here in the United States. So the Europeans, which were overly dependent on Russia for their gas supplies, can no longer count on this source. So what they've had to do is move into the US LNG market. And more of these cargoes over the past year have been flowing towards Europe. Now, the problem here is that at the beginning of the summer, a major export facility in the Gulf Coast, Freeport LNG, had an incident. They had to shut down their output. That is 1/5 of US export capacity. Unfortunately, now rumors are persist in the market that a partial restart of this export facility, which was initially planned for next month in October, likely won't come on until the first quarter. So essentially, Europe is going to have to endure this winter before any of this gas can get back into the market, and therefore these high prices are here to stay.
And this next chart, it gives us some insight into just how serious the gas crisis is, and in particular, how the price of gas has decoupled from the price of oil. When did this decoupling begin?
The decoupling began right after or soon thereafter. We saw the cut in carbon permits and the massive transition in demand in Europe from steel makers, aluminum smelters, fertilizer producers. They moved out of coal, they moved down to natural gas. So prices began to decouple in early 2021. Of course, now since February of this year, that decoupling has accelerated. A couple of weeks ago, we traded almost the equivalent of $600 barrel oil. And this is how the natural gas market has changed over the years. Traditionally, what you had was a very simple market. And so your price was set between your producing area and your consuming area. 10 years ago, an event in the Ukraine or in Europe, an event in Asia would have no impact on natural gas prices here in the United States. But because we are a burgeoning powerhouse in the global LNG market, now global events now impact the market. So this just gives you an idea of how volatile the energy sector is and shall remain volatile going forward, because now the rumors are Freeport won't come online until the end of November to the first quarter. And this is going to continue as those headlines persist, continue to inject volatility and likely higher prices. And this is stemming from the global market for LNG as opposed to the domestic market.
Well, volatility is certainly a theme in all asset classes we're seeing. And this next chart is showing that, at least in terms of oil price, we may have some relief soon.
In terms of oil prices, we have the dollar relationship. Now, keeping in mind that global commodities, the majority of these commodities, trade in US dollars. So there is historically an inverse relationship between the price of commodities and the price of, or the value of the dollar. As the dollar falls, commodity prices are cheaper in non-dollar denominated economies. These correlations are not perfect, and they sometimes decouple. And in the first half of this year, what we saw was this decoupling where we had persistently high commodity prices as the dollar was rising. So as the cost for commodities was growing, the demand continued to grow as well. Now, beginning right around July 1st, so the start of the second half of this year, we saw this correlation build again as the dollar has risen, and the dollar is now trading at 20-year highs. We're seeing the pullback in prices. So as we are looking at these much higher costs in Europe, we're seeing plants close down, steel mills have to shutter, aluminum smelters, fertilizer parts, and this is contributing to higher persistent prices and higher inflation going forward.
Now, we're going to transition to some questions around exploring the seriousness of the energy crisis. Germany is saying that this crisis could lead to a Lehman Brothers moment. Just how serious is this energy crisis?
I think the global energy market has never been at a crisis point at this highest level, and we've never seen a situation like this. So I think what's important for people listening and watching is to appreciate that energy not just the energy that we put into our cars or we use to heat our homes and cool our homes. It is the energy that impacts everything that touches our life. For instance, natural gas is the primary feedstock to ammonia nitrate. Ammonia nitrate is fertilizer. So the cost for farmers to put a seed into the ground has exploded this past year. Corn production will be at a 5-year low because corn requires a very large degree or amount of fertilizer. So farmers this year put in more soybeans than they put in corn. And at the same time here in the United States, we lifted the mandate on the amount of ethanol, that is corn, that can go into the gasoline blend stock. So we increased our demand for corn over this summer at a time where corn planting was at a 5-year low. So the foot that is now on the consumer neck is not necessarily energy, but it is food inflation. And of course, this food inflation is being compounded by the lack of exports coming out of Ukraine, which is essentially the breadbasket of Europe. So we have two situations on both sides of the Atlantic where our crop yields this fall harvest are going to be lower than normal at a time where demand is going to be very high. So as a direct impact of the war on natural gas, it's a war on fertilizer, therefore it's a war on the farmer. Now the big difference here from an energy standpoint, I can alter my demand for energy. From a transportation standpoint, I can work remotely, so I've cut my demand for gasoline. What I cannot alter my demand for is food. I need to eat. You need to eat. So that demand is not going away, and the fear now is as interest rates around the world continue to rise, the cost of money continues to rise, we run the threat now of a significant pullback in economic demand, i.e. a recession that could be on scale with what we saw during the Great Recession.
A double whammy on the cost of food. And as we mentioned earlier, the Northern Hemisphere is heading into winter. How is that going to impact the current energy crisis?
Yeah, absolutely. It's certainly going to compound it and make it worse because utilities are more reliant on natural gas as they were even 10 years ago. We have fewer nukes, our nuclear energy out there, and we have fewer coal plants out there. So we're on this hamster wheel where these higher energy prices will continue to tamp down consumer demand and therefore runs the risk of severe economic contraction.
That is quite alarming. And with the cost of gas sky high right now, we're starting to see the prices of substitutes like coal begin to surge. What are some of the other substitutes that are rising and how can you trade them? Is the futures market an opportunity for traders right now?
Right now for traders, a number of avenues. We're looking at a situation now where the majority of investment dollars have been going into renewables over the past couple of years. But now, because of the lack of renewables or the increased demand for fossil fuels, we've underinvested for the past 2 years. So we're going to have a large amount of dollars going into that infrastructure. So in the United States, what does that mean? It means more investment into natural gas production, means more investment into export capacity, export facilities, and then all the associated commodities that are related to that. So there's more cement that is required for wells. There's more metal, steel demand for the rigs. Now, what does that mean in Europe from an investment standpoint? Well, what Germany has had to do, they've had to reverse course. They have to start building natural gas import facilities. So once again, exposure to companies that are related to the physical demand for fossil fuels. There's a tremendous trading and investment opportunity in these companies.
And you mentioned renewables earlier. So is now the time to invest in things like green energy tech firms, rare earths miners, and electric car makers, for example?
No, I don't think so. I drive an electric hybrid. I love it. I love electrics because they save me money in my pocketbook. They're great for the time being. I am under no illusion, and no one out there should be under the illusion that you are doing something good for the earth. You're not. For instance, the amount of rare earth metals that we're going to have to tear the earth apart to get to for our battery storage will make 130 years of oil production and coal mining look like just a scratch of the earth. And what we've seen here in the United States, for instance, is the negative impact on the environment related to solar panels. 20-odd years ago, California encouraged consumers to switch over to solar, and it was great. Now, those old solar panels is California and many economies around the globe do not have a plan to dispose of these solar panels. So solar panels, these old generation panels, are now filling up landfills in California. I think renewables are great, but they're certainly not the panacea as far as the environment is concerned. So investments in renewables at this point is a loser, both from a monetary standpoint and from a social standpoint.
What about in terms of nuclear energy? After Fukushima, nuclear energy was pushed to the back burner, but could nuclear be the solution?
Nuclear is the solution as far as the environment is concerned. There's been a lack of investment over the past 2 generations here in the United States. Of course, that stemmed from the 3 Mile Island incident. Of course, we've had Chernobyl, and to your point, we've had Fukushima. But at this point, nuclear is the answer. Now, the problem with nuclear, of course, there is a potential catastrophic, but certainly we've seen greater moves in technology and in construction in plants. So nuclear is much safer than it had been in the older generation plants. And then from a cost perspective, from an environmental perspective, nukes do not have any emission issues. So for the environment, it is a very worthwhile endeavor. So what we've seen in the Ukraine here is a push, and it's rejuvenated not only the fossil fuel market, but certainly down the road, the nuclear market as well.
And speaking of Ukraine, so just to throw that out there, there's a possible scenario where the conflict suddenly ends and Russian gas came back online. If that were to happen, what impact would that have on the global energy market?
It would have, at this point, unfortunately, a rather de minimis impact because we have the loss of Nord Stream. Now, what we know now is we've had 3 to 4 undersea explosions. The headlines now is that this is sabotage. I don't know who sabotaged it, but you have to follow the money and who stands to benefit from that. The lack of Nord Stream means higher natural gas prices, so Moscow certainly benefits. So as Europe becomes more reliant, especially on US LNG, then it costs a lot of money to take LNG, freeze it, put it onto a tanker, ship it, pay the transport costs to move that tanker around to Europe, regasify, and get it into the stream. So that adds an extra cost. And what Europe will have to contend with as well is competition coming from Asia. We're still looking at a higher for longer energy situation in Europe.
So is there a scenario where this energy crisis comes to an end without Russia pulling out of the conflict in Ukraine?
Yes, and it's not a pretty one, and I don't want to say it, but it is the same situation that we saw in 2008. Now here in the United States, the real estate bubble and nefarious types of investments were the catalyst, but what we saw prior to that was a major uptick in energy prices to unprecedented levels. In 1999, oil prices were trading at $9 a barrel. By 2008, they were trading at $150 a barrel. So that impact to the consumer certainly was a contributing factor, the other major contributing factor to the global economic recession. And this is the steps that the Fed is taking with its interest rate policies. Jay Powell at the Fed really doesn't have an option other than to tank the economy. And this unfortunately stems from the fact that he and a lot of the powers that be completely ignored the potential of higher inflation. They continue to pour more stimulus dollars into the economy. Inflation is super high, and we're going to have to destroy the economy or certainly tank the economy to tame inflation. From what I can see, that is really the only driver, and it's not a pretty one, that is going to pull energy prices lower without Russia or resolution in Ukraine.
Well, thank you very much for joining us today, Stephen. That was Stephen Schork, editor of the Schork Report, providing fundamental analysis and technical of the energy market. You've been listening to episode 6 of IC Your Trade. IC Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade up to IC Markets. In our next episode, we look at environmental, social, and governance, or ESG. Is it the greatest investment opportunity since the emergence of the internet? Thank you for joining us today, and we look forward to seeing you next time.